There's something different about dividend investors who actually escape the rat race. While everyone else chases quick gains and crypto moonshots, these quiet wealth builders think completely differently. They have several specific psychological traits that separate them from the pack, and once you understand these mental patterns, you'll see why they consistently build wealth while others stay trapped. Today, I'm breaking down the exact psychology that turns ordinary people into dividend millionaires. Meet Sarah, a 42-year-old marketing manager who walked into her boss's office last month and quit. No backup plan, no inheritance, no lottery ticket. Just a dividend portfolio that now generates $4,200 every single month in passive income. What makes Sarah different isn't her investment picks or her market timing. It's how her brain works. She thinks about money, time, and investing in ways that most people never learn. But here's what might surprise you most about dividend investors who successfully escape the rat race. They actually share a psychological trait with pathological gamblers. I'll explain exactly what that is and why it's actually their secret weapon for building wealth. The first psychological pattern that separates successful dividend investors is what I call delayed gratification mastery. This isn't just about waiting for results. It's about finding genuine satisfaction in the waiting process itself. Sarah started her dividend journey 8 years ago with $3,000. In year one, she received exactly $96 in dividends. Most people would see that pathetic return and immediately switch strategies. Sarah felt excited. This psychological difference runs deep. When researchers study the brains of successful long-term investors using MRI scans, they find unusual activity in the prefrontal cortex when these investors think about future rewards. Their brains literally light up differently when considering long-term gains versus immediate gratification. They've rewired themselves to feel pleasure from patience. But delayed gratification alone isn't enough. The second psychological trait is what psychologists call outcome independence. Successful dividend investors develop an emotional detachment from daily market movements that borders on supernatural. They check their portfolios, see red numbers, and feel nothing. They see green numbers and feel nothing. Their emotional state isn't tied to short-term portfolio fluctuations. Sarah tells me she once went 3 months without checking her dividend account during the 2020 market crash. Not because she was scared, but because daily movements simply became irrelevant to her mental framework. This isn't denial or avoidance. It's a conscious psychological shift where you stop measuring success by account balances and start measuring it by dividend payments received. This mindset creates a compound psychological effect. When you're not emotionally invested in daily market drama, you make better decisions. You don't panic sell during crashes. You don't FOMO buy during bubbles. You just keep buying quality dividend stocks at regular intervals, regardless of what everyone else is doing. The third psychological trait might be the most important. They think in terms of cash flow, not net worth. This mental shift changes everything about how you approach investing. Most people obsess over their total account value. Dividend investors who escape the rat race obsess over monthly income streams. Let me give you a concrete example. Two investors each have portfolios worth $200,000. Investor A owns growth stocks with zero dividends, but has gained 20% this year. Investor B owns dividend stocks yielding 4% annually, generating about $667 monthly in dividends. Most people would say Investor A is winning. The successful dividend investor, psychology sees Investor B as closer to financial freedom. Why? Because Investor A's gains only matter if he sells. The moment he needs money, he has to liquidate assets. Investor B receives predictable cash flow every month without touching the principal. One builds wealth on paper, the other builds wealth in cash. This cash flow mindset creates what I call the replacement income framework. Sarah didn't think about accumulating enough money to retire. She thought about replacing her income with dividends. Her monthly expenses were $3,800. Her goal wasn't to reach some arbitrary net worth number. Her goal was to generate $3,800 in monthly dividend income. This psychological reframing makes the path to financial independence concrete and measurable. Instead of asking, "How much money do I need to retire?" you ask, "How much dividend income do I need to cover my expenses?" The answers feel completely different emotionally. The fourth psychological trait is systems thinking over goals thinking. Most investors set goals like, I want to make 10% returns this year, or I want to double my money in 5 years. Dividend investors who escape the rat race focus on systems instead. They build repeatable processes that compound over time. Sarah's system was simple. Every month, she invested exactly $800 into dividend-paying stocks. She didn't adjust based on market conditions. She didn't skip months when money was tight. She didn't invest extra when she got bonuses. $800 every single month for 8 years. That system became more valuable than any individual investment decision. Systems thinking creates psychological momentum. When you follow the same process consistently, you build identity around that process. Sarah stopped seeing herself as someone trying to invest money. She became someone who invests money. The behavior became part of her core identity, making it effortless to maintain long-term. This identity shift explains why successful dividend investors rarely quit their strategies. It's not willpower keeping them consistent. It's identity. They're not forcing themselves to invest in dividends. They're just being themselves. The fifth psychological trait is what I call productive pessimism. Successful dividend investors assume everything will go wrong and plan accordingly. They expect market crashes, dividend cuts, economic recessions, and personal financial emergencies. This isn't negative thinking. It's strategic paranoia that leads to better decision-making. Sarah never invested in a single dividend stock without researching the company's dividend history during previous recessions. She assumed her job income would disappear at the worst possible moment. She assumed interest rates would rise and tank dividend stock prices. She assumed inflation would erode her purchasing power. Then she built a portfolio designed to survive all those scenarios. This pessimistic planning creates psychological resilience. When bad things actually happen, dividend investors who escape the rat race feel prepared rather than panicked. They've already mentally rehearsed worst-case scenarios and built defenses against them. But here's the psychological paradox. This pessimistic preparation leads to optimistic outcomes. By expecting the worst and planning for it, they create investment strategies robust enough to thrive in any environment. Their pessimism becomes their competitive advantage. Now, here's that surprising psychological trait I mentioned earlier that dividend investors share with pathological gamblers. Both groups become completely obsessed with tracking patterns and numbers. Gamblers obsess over betting systems and odds calculations. Successful dividend investors obsess over dividend growth rates, payout ratios, and yield calculations. But there's a crucial difference. Gamblers track patterns in random events. Dividend investors track patterns in business fundamentals. Both groups spend hours analyzing data, but dividend investors analyze data that actually predicts future outcomes. They channel the same obsessive personality type toward activities that build wealth instead of destroying it. Sarah keeps spreadsheets tracking every dividend payment she's received for 8 years. She knows exactly which companies have increased their dividends, by how much, and when. She tracks reinvestment rates, tax implications, and portfolio allocation percentages. This level of detailed tracking would seem obsessive to most people. For successful dividend investors, it's just Tuesday. This obsessive tracking serves multiple psychological purposes. First, it reinforces the delayed gratification mindset by making small progress visible. When you track every dividend payment, you see your income growing month by month, even when the amounts feel small. Second, it builds confidence through data. Instead of hoping your strategy works, you have concrete evidence of progress. The sixth psychological trait is emotional immunity to social pressure. Dividend investing isn't sexy. Nobody brags about their 4% yields at parties. You won't impress anyone by talking about your utility stock holdings. Successful dividend investors develop complete immunity to financial peer pressure. While their friends chase meme stocks and crypto moonshots, dividend investors who escape the rat race stick to their boring strategies. They watch friends make and lose fortunes in growth stocks without feeling any urge to join the excitement. This psychological independence is crucial because the path to financial freedom through dividends requires doing the opposite of what everyone else is doing. Sarah worked in marketing, surrounded by colleagues constantly talking about their latest investment wins. Tesla gains, Bitcoin profits, GameStop madness. She never once felt tempted to abandon her dividend strategy to chase those trends. She had developed what psychologists call reference point independence. Her reference point for success wasn't other people's gains. It was her own progress toward financial independence. The seventh psychological trait is what I call abundance scarcity. This sounds contradictory, but successful dividend investors think about money with abundance mindset and scarcity discipline simultaneously. They believe there's unlimited opportunity to build wealth, but they treat every dollar as precious. This dual mindset shows up in how they research investments. They spend weeks analyzing a single dividend stock before buying, treating their investment dollars as irreplaceable. But they also believe they can find unlimited high-quality dividend opportunities if they're patient and thorough. Scarcity makes them careful. Abundance keeps them optimistic. We're about halfway through understanding the psychology of dividend investors who escape the rat race, and you're already seeing how different their thinking patterns are from typical investors. But here's where things get really interesting. I've been focusing on psychological traits that help people build dividend wealth, but there's a darker side to this psychology that can actually trap people in poverty forever if they're not careful about it. Some people develop what looks like dividend investor psychology, but they're actually using these same mental patterns to avoid building real wealth. They become so focused on safety and predictability that they never take enough risk to actually escape the rat race. They think they're being smart dividend investors, but they're actually just sophisticated savers earning barely enough to keep up with inflation. The difference between dividend investors who escape the rat race and those who stay trapped comes down to one crucial psychological factor. They understand that dividend investing is still risk-taking, just smarter risk-taking. They're not trying to avoid risk. They're trying to take calculated risks that compound over time. This brings us to the eighth psychological trait: intelligent risk appetite. Successful dividend investors aren't conservative investors who happen to buy dividend stocks. They're aggressive wealth builders who use dividend stocks as their weapon of choice. They understand that not taking enough risk is actually the biggest risk of all. Sarah didn't start with $3,000 and gradually build to financial independence by playing it safe. She consistently invested $800 per month even when it felt uncomfortable. Some months that represented 20% of her take-home pay. She was taking significant risks with her lifestyle to fund her dividend strategy. But here's the psychological key. She didn't feel like she was taking risks. She felt like she was guaranteeing her future financial freedom. This mental reframing allowed her to take larger risks than she would have if she viewed dividend investing as risky behavior. She saw not investing as the risky choice. The ninth psychological trait is systems optimization over perfection seeking. Dividend investors who escape the rat race constantly improve their strategies, but they never wait for perfect strategies before starting. They embrace what psychologists call satisficing behavior, finding solutions that are good enough to move forward with. Sarah's first dividend stock purchase was Coca-Cola because she understood the business model and knew they paid dividends. Was it the optimal choice? Probably not. Did it get her started building wealth through dividends? Absolutely. She optimized her strategy over 8 years, but she never let optimization paralysis prevent her from taking action. This psychological approach prevents the analysis paralysis that keeps most people stuck in planning mode forever. They research until they find investments that meet their basic criteria, then they buy and improve their approach over time. The 10th psychological trait is what I call future self-visualization. Successful dividend investors don't just think about building wealth. They create detailed mental pictures of their lives after escaping the rat race. This visualization becomes their psychological anchor during difficult periods. Sarah spent time every month visualizing her life after reaching financial independence. She pictured waking up without alarm clocks, spending time with her family, pursuing hobbies without worrying about income. This wasn't daydreaming. It was strategic psychology. The clearer her vision of financial freedom, the easier it became to make short-term sacrifices to achieve it. This future self-visualization serves multiple psychological purposes. It maintains motivation during boring periods when dividend investing feels slow. It clarifies decision-making by connecting daily choices to long-term outcomes. And it builds emotional momentum by making abstract financial goals feel concrete and personal. The 11th psychological trait is growth mindset about money. Dividend investors who escape the rat race believe their ability to build wealth can be developed through learning and effort. They don't see themselves as naturally good or bad at investing. They see themselves as people who can get better at investing through practice. This growth mindset shows up in how they handle mistakes. When Sarah bought a dividend stock that later cut its dividend, she didn't see it as proof she was bad at investing. She saw it as valuable learning experience that would help her make better decisions in the future. She analyzed what went wrong, adjusted her research process, and moved forward with better knowledge. The final psychological trait that separates dividend investors who escape the rat race is what I call lifestyle inflation resistance. As their dividend income grows, they resist the urge to immediately increase their spending. This psychological discipline accelerates their path to financial independence exponentially. Most people increase spending as income increases. Successful dividend investors do the opposite. As dividend income grows, they reinvest it to generate even more dividend income. Sarah's first monthly dividend payment was $8. Instead of spending it, she used it to buy more dividend stocks. By year 3, her monthly dividends were covering her car payment. Instead of relaxing, she reinvested that money too. This resistance to lifestyle inflation requires tremendous psychological discipline because it means delaying gratification even after you start seeing results. But it's this exact trait that separates people who build real wealth from people who just have higher incomes. The psychology of dividend investors who escape the rat race isn't complicated, but it is uncommon. They think long-term in a short-term world. They find satisfaction and patience when everyone else wants instant results. They focus on income generation when everyone else obsesses over account balances. They take calculated risks when others either take foolish risks or no risks at all. Sarah's story isn't unique among successful dividend investors. It's actually quite typical. The psychological patterns I've outlined today show up again and again in people who successfully build financial independence through dividend investing. The good news is that these psychological traits can be developed. You don't have to be born with them. Understanding these psychological patterns is just the first step. The next step is figuring out exactly how much dividend income you actually need to replace your job and achieve financial independence. The numbers might surprise you, and they're probably different than what you think. I break down the exact calculations and show you real examples in my video how much you actually need to quit your job with dividends. Surprising. Check it out at the link in the description. The specific dollar amounts will change how you think about your timeline to financial freedom. The psychology gets you started, but the numbers show you exactly where you're going.